This ETF claims to provide 4x dividends compared to the S&P, while it invests in the S&P. Is it a scam? Let's find out. This video is not financial advice, nor is it a recommendation. Please do your own due diligence before investing into anything. QDPL is a pacer ETF that buys the S&P 500 stocks in similar balance and proportion to the index and uses a future strategy to attempt to provide 4x dividends compared to normal direct investment in the S&P. When you invest your cash into QDPL, they buy each of the individual stocks of the S&P 500. Then, they also buy what are called dividend futures. Dividend futures are similar to normal futures in that these contracts are an agreement to buy a given asset at an agreed-upon strike price at an agreed date. However, unlike an options contract with futures, the buyer does not have the option to let their contract expire worthless. They have to buy whatever they agreed to buy. Dividend futures are a futures contract in which the buyer and seller agree to exchange the value of dividends for a given stock, or in this case, the index. The buyer pays the price of the contract, and in return, the seller pays the buyer the dividends they received from holding the S&P 500. The buyer is essentially betting that the actual dividends will be greater than what they paid in premiums on the futures contract. This bet is how QDPL intends to deliver 4x the normal dividends of the S&P. So far, VOO, an S&P 500 ETF, has a dividend yield of 1.29%. SPY has a dividend yield of 1.23%, and QDPL has a dividend yield of 5.52%. So thus far, it seems to have delivered on the 4x dividends target. As for capital appreciation, looking at the daily charts from the S&P's bottom in October of 2022, it can look like this ETF is doing amazing. However, it's important to note that while this ETF has come a long way since its all-time lows, it's currently sitting just shy of $38, and it opened on inception at $34.75. If we look at the total return of QDPL since its inception date compared to just investing in the S&P directly at the same date, according to Seeking Alpha, the direct investment into the S&P would have narrowly beaten the returns of QDPL. QDPL came in at a total return of 32.91%, while the S&P comes in at 37.05%. If you're asking yourself if you should invest in QDPL, you first have to look at your own goals. Are you looking to replace your income with dividends? Or are you trying to grow your nest egg to eventually switch over to investments with higher cash flow at retirement? No matter which camp you're in, QDPL excels at neither of these. Sure, it pays higher dividends than the S&P, but not high enough to make you pick QDPL over other higher-paying dividend ETFs. It delivers higher capital appreciation than most of the high dividend covered call ETFs, but not enough to pick QDPL over purely growth stocks. It's also important to note that while this ETF is pretty middle of the road, it also charges you a 0.6% expense ratio, which used to be 0.79% before February 1st of this year. Are you investing in this ETF? Why or why not? If you like this video, you might also enjoy this one here on the screen. Subscribe to join the Cash Flow Club and hit the bell for notifications so you don't miss a single video.